Between 1990 and 2003, 212,000 companies went bankrupt. In the same period, the stock market dropped by 80%. Land prices in the major cities fell by up to 84%.
毎日って言っても過言ではないぐらい首吊りしたりとかいなくなっちゃったりとかそういう記事は、新聞紙面には流れましたね。
The Japanese yen is currently trading at a 38-year low against the US dollar. This has led to a surge in American tourists visiting Japan, with over 900,000 people arriving in the first 5 months of 2024 alone, a 17.4% increase from last year. This influx is evident on social media as the weakened yen has made Japan a more attractive destination. One US dollar now exchanges for approximately 160 yen, a rate last seen in May 1986, nearly 40 years ago. From 1981 to 1991, whenever a company launched an IPO, the average first-day return was 32%. In comparison, today's stock market returns an average of 7 to 10% per year, not 32% per IPO for a decade straight. This led to people investing blindly. For instance, in 1987, around 10 million people applied to buy shares in a telecom stock without knowing its valuation. This stock eventually soared to a price-to-earnings ratio of 200 and was valued at $376 billion, making it worth more than the entire stock markets of Germany and Hong Kong combined. Stock prices began to rise 3 times faster than corporate profits, with some stocks trading between 100 to 400 times their price-to-earnings ratios. The peak occurred in 1989 when the Japanese stock market hit an average PE ratio of 225, which is extraordinarily high compared to a healthy PE ratio, which should be about 10 times lower. By 1989, the Japanese stock market had grown so large that it was worth about half of the entire world stock market, approximately $4 trillion. It's estimated that about 38% of real estate purchases were made by corporations, and by 1980, corporations owned about 2/3 of the entire stock market. The Plaza Accords' focus on deregulation further fueled this growth, much of which was funded by unregulated shadow banks. Eventually, the bubble burst in the early 1990s, causing property values and the stock market to collapse. The Central Bank of Japan had to intervene by slashing interest rates to nearly zero and injecting money into failing banks. This intervention created zombie companies that couldn't repay their debt or invest in capital. Japan didn't let these businesses fail to avoid job losses, so they continued to pump money into the economy. However, it was too late and trust was lost, marking this period as the lost decade. In the end, the lost decades cost Japan an estimated 17 million jobs, leading to financial instability and widespread depression among the population. In 2016, the Bank of Japan dropped the key interest rate to a negative 0.1%. This move didn't mean people were paid to take out loans, but it aimed directly at commercial banks. The idea was that if it cost banks money to hold customer deposits, they would be motivated to lend out as much money as possible. This policy was a way for the Central Bank of Japan to force commercial banks to stimulate borrowing and spending, a strategy known as quantitative easing. The Bank of Japan wasn't alone in adopting negative interest rates. The Danish Central Bank set negative rates in 2012, followed by the European Central Bank in 2014 to combat deflation. Later that year, the Swiss National Bank, and in 2015, Sweden's central bank adopted similar measures to prevent excessive currency appreciation and boost inflation and economic growth. Despite these efforts, Japan's major issue persisted: its aging population. This demographic challenge continued to hinder economic recovery and growth. Japan has one of the world's highest life expectancy rates and one of the lowest birth rates globally.
Japan has one of the fastest declining populations in the world. From the current 124 million, the number is expected to drop below 100 million by 2056. By 2100, the population will likely be half of what it is now.
According to the World Economic Forum, as many as 1 in 10 people in Japan are over the age of 80. Japan's workforce is shrinking, which strains its economic growth. A larger elderly population means higher healthcare and pension costs, making it challenging for the Bank of Japan to justify raising interest rates when the population is already struggling. This is why interest rates remain negative for 8 consecutive years. The Bank of Japan only raised interest rates in 2024, marking the first increase in 17 years.
Well, the Bank of Japan, the BOJ, is raising interest rates for the first time in 17 years today, making it the last major central bank to exit the world's negative rate policy.
The question is, how does all of this relate to the collapsing yen and the strength of the US dollar? Typically, the yen increases in value when there are recession fears, but we've seen the opposite recently. The US economy has been very strong, even with high interest rates. These high rates have attracted a lot of money into the US economy, boosting the US dollar and weakening the yen. Japan is currently criticized for not doing enough to encourage people to invest in the yen, as interest rates remain close to zero, offering no incentive. According to Sachs, the outlook for the yen remains weak for the foreseeable future. Remember, the strength of a currency largely depends on the central bank's interest rate. The more expensive it is to borrow money, the more valuable the currency tends to be. Conversely, the cheaper it is to borrow, the less valuable the currency becomes. Right now, borrowing US dollars is quite expensive at around 5.2%, whereas borrowing yen is very cheap. Now, if you like this video, check out this next video right here.